All right, let's dive right into this expert analytical report. Look, if you've ever moved across borders, you already know the immigration paperwork is a nightmare. But here's the thing, the biggest trap isn't actually the visa. It's the implicit assumptions people make about their taxes. So today, we're going to bypass all that generic surface level advice and really dissect the hidden architecture of transitional tax liability. We're exploring the strict cause and effect mechanisms of how sovereign tax systems process your arrival and departure, and why getting this wrong can literally be financially devastating. We are going to unpack exactly what happens under the hood of your finances when you cross international lines for good. To unpack this, we're going to follow a strictly logical framework. First up, tax versus immigration classifications. Second, the dual status mechanism. Third, default restrictions. Fourth, strategic spousal elections. Fifth, treaty overrides. And finally, procedural execution. Let's get into it. Section 1, tax versus immigration classifications. So the crucial point to understand right off the bat is that a change in your physical location or legal immigration status does not instantly flip your tax responsibilities. The expert analysis makes it absolutely crystal clear. Statutory disconnect means that tossing out a permanent residency card or simply leaving a country for a few months doesn't magically erase your classification as a resident taxpayer. Immigration law is strictly designed to dictate where your physical body can legally stand. Tax law, that entirely separately dictates what percentage of your wealth the government can legally access. These are parallel tracks, not overlapping ones. To really grasp the stakes of getting this classification wrong, we have to look at the massive contrast in liability. A resident taxpayer operates under a global burden, meaning every single dollar you earn anywhere on Earth is subject to domestic taxation. A non-resident, however, enjoys a highly localized burden. They're taxed exclusively on domestic source or effectively connected income generated strictly within that specific host country's borders. It's a literal binary switch with massive financial implications. It fundamentally changes the entire reach of the government into your personal ledger. Okay, moving to Section 2, the dual status tax mechanism. The cause and effect relationship here is that arriving or departing mid-year legally splits your tax calendar into two entirely distinct frameworks. You aren't a blend of the two statuses. You are sequentially one and then the other within a single fiscal year. This structural bifurcation requires you to calculate your financial life through two completely different legal lenses. You essentially have to close the financial books on one legal reality, draw a hard line on a specific date, and immediately open brand new books under a totally different set of rules for the remainder of the year. Think of your timeline almost like a physical shield. During that initial non-resident period, that statutory shield protects your foreign income from the host country's tax authorities. But the exact moment you cross that statutory threshold into residency, the shield drops, and the system instantly begins capturing all your global earnings. The exact date of your transition is the pivot point where your worldwide wealth suddenly becomes totally visible to the domestic tax agency. Which brings us to Section 3, default restrictions. Now, the expert analysis highlights a pretty brutal mechanism here. The statutory framework strictly strips away crucial economic buffers because you're only part of the domestic system for part of the year. The government's default setting is to heavily penalize that bifurcated year. They aren't going to grant full-year tax benefits to someone who is a non-resident for 6 months, right? So if you default to dual status, you automatically lose the standard deduction. If you're married, you're forced into the higher, far more punitive married filing separately brackets. You forfeit educational credits and age or disability-related benefits. The underlying assumption built into the law is that part-year residents simply do not get full-year privileges. Faced with those severe penalties, you really have to run a strategic cost-benefit analysis. Is there a way to reclaim your standard deductions and normal tax brackets? Well, yes, but it requires a highly calculated, counterintuitive trade-off. You have to decide if sacrificing that non-resident shield, the one protecting your global income, is actually worth the cost to regain your fundamental tax deductions. And that leads right into Section 4,
Strategic spousal elections.
So there are two primary spousal residency elections to solve this mess. Mechanism A allows a full-year non-resident to essentially piggyback on their resident spouse's status for the entire year. Mechanism B allows a mid-year arrival to retroactively apply resident status to the very beginning of the year. Both of these mechanisms unlock highly advantageous joint filing privileges and restore your standard deductions. The implicit assumption here is that you absolutely must run the math. Does the tax savings from joint filing and reclaimed deductions actually outweigh the brand new tax burden placed on your previously shielded global income? Section 5, the first-year choice mechanism. But what if you're an independent arrival without a resident spouse? Well, you aren't completely locked out of strategic elections. By executing these strict chronological steps, a non-resident can strategically elect resident status for the tail end of their arrival year. This is a brilliant example of statutory cause and effect. You must establish a 31-day absolute continuous presence, maintain a 75% presence ratio for the rest of that year, and practically guarantee you'll meet the full residency test the following year. Because you mathematically cannot prove you meet the subsequent year's presence test until that future actually happens, this maneuver inherently forces you to file a procedural extension. You're actively delaying your current year's taxes until the next year's reality is officially secured.
All right, Section 6, International Treaty Tiebreaker Rules.
Now we are moving beyond internal mechanisms and jumping into international conflict resolution. This creates a dual resident conflict, which is fundamentally distinct from the dual status transition year we analyzed earlier. Dual status means two tax rules in 1 year in one country. Dual resident means two entire countries are looking at your global income right now, simultaneously demanding their cut. Internal tax laws are basically blind to each other. They just enforce their own codes until an international treaty legally forces them to acknowledge the conflict. Left unresolved, this leads to absolute double taxation. To override this double taxation, international treaties apply a super strict sequential tiebreaker hierarchy. It's a rigid algorithm. First, where is your permanent home? If you happen to have a home in both countries, the system steps down to level 2. Where is the center of your vital personal and economic interests? Like where is your bank, your family, your primary business? If that's still ambiguous, it moves to your habitual abode and finally drills all the way down to your raw citizenship. You literally cannot skip these steps. You don't jump straight to citizenship if you have a habitual abode. You must follow the sequence exactly, step by step, until the tie is legally broken.
Finally, Section 7, Procedural Filing Execution. Having navigated all those mechanisms, the default traps, and the strategic elections, we finally conclude with the physical execution rules. How do you actually submit this complex reality to the authorities? Well, the expert report establishes an absolute, non-negotiable rule. Your document arrangement is based entirely on your status on the very last day of the year. December 31st is the only day that matters for determining the architecture of your paperwork. Why? Because the system requires a definitive, static snapshot in time to orient the bureaucracy, completely regardless of whatever chaos happened in June or July. So there's actually an inverse physical relationship for the paperwork depending on your trajectory. If you arrived and became a resident by year end, the resident tax form acts as the main cover sheet, with the non-resident period attached behind it as a secondary statement. Conversely, if you gave up residency and departed, the non-resident form becomes the main cover sheet and the resident period is tucked behind it. The anchor date determines the cover sheet. Here is a totally non-obvious but absolutely vital detail for execution: the requirement to manually label the compiled documents. Because these bifurcated returns require manual review, failing to write dual status return boldly across the top of the primary document creates a disastrous cause and effect loop. Without the label, a human won't review it. Instead, a machine will process it as a standard return, leading to massive automated processing errors, huge miscalculations of your liability, and almost certainly completely unnecessary audits. Okay, let's synthesize the core actionable insights we've pulled from this analytical report. Walk through the logic chain with me one more time. It all starts with a statutory disconnect, understanding that visas and taxes are parallel tracks. Arriving mid-year forces a dual status bifurcation, which then traps you in highly punitive default restrictions. You can escape those restrictions through strategic spousal or first-year elections, but you must calculate if the restored deductions are actually worth exposing your global income. If two countries claim you, sequentially apply treaty tiebreakers. And finally, let December 31st strictly dictate your physical paperwork.
I'll leave you with this final provocative thought to analyze for your own situation. Our basic instinct is almost always to hide global income at all costs, right? But as this expert report reveals, sometimes proactively embracing a broader tax base and submitting to global taxation in your transition year is the exact strategic mechanism needed to unlock massive deductions, reset your financial standing, and protect your long-term wealth. Thanks for joining us on this explainer. Keep analyzing the systems around you, and we'll catch you next time.